Markets are shaking tonight, not because of a single headline or an isolated event, but because several powerful stories are colliding at the same time. What we're seeing is not random turbulence or background noise. A major policy narrative that has shaped markets, politics, and investor expectations for years is starting to unravel in public. At the same moment, warning signs are emerging inside United States jobs data that most people never see highlighted on the front page. And while official commentary continues to emphasize optimism, resilience, and growth, some of the largest and most influential United States technology stocks are quietly losing value beneath the surface. These developments are not happening independently. They are connected, and together they are reshaping the economic landscape in ways that are becoming harder to ignore. Over the past several months, government officials and influential media voices have aggressively promoted the idea that the United States can pressure, isolate, or even economically cancel China without facing serious consequences at home or abroad. That narrative has been presented as both inevitable and manageable. But now it is being tested in real time, largely behind closed doors. What is becoming increasingly clear is that parts of this strategy are already pulling back. Some initiatives are being delayed, others are being softened or quietly reworked. The tone remains firm in public, but the actions tell a more cautious story. Markets, as always, are reacting faster than policymakers expected because investors tend to respond to direction and uncertainty long before official decisions are finalized. At the same time, the official story around employment no longer matches what is happening beneath the surface of the labor market. On paper, the jobs picture appears stable and even healthy. Headline employment numbers suggest strength and resilience. But when the data is broken down, a different reality emerges. The quality of jobs is deteriorating. Full-time employment is shrinking while temporary and part-time roles are expanding. Revisions to prior months quietly erase earlier gains that once supported optimistic narratives. Some sectors are actively shedding workers, while others remain afloat only because of government support or temporary demand. These details rarely dominate headlines, yet they matter far more than a single top-line figure when it comes to understanding the true health of the economy. Now add technology stocks to this picture. For years, the technology sector carried the broader market, acting as its primary engine of growth. Artificial intelligence enthusiasm pushed valuations to historic extremes, and investors were repeatedly told that these companies were untouchable, immune to broader economic forces. That assumption is now being challenged. Rising costs, softer demand, persistent supply chain pressure, and growing policy risk tied directly to China are hitting the tech sector from multiple directions at once. Some of the biggest and most recognizable names are already down sharply from their peaks. Others are being supported less by fundamentals and more by hope, momentum, and expectations that conditions will somehow reverse. Here is the critical point that most people miss. These stories are not separate developments unfolding in isolation. The push to confront and economically distance from China directly affects global supply chains. Those supply chain disruptions hit technology companies first because they sit at the center of global production networks. Weakness in the tech sector then feeds back into hiring decisions, as companies slow expansion, pause recruitment, or shift toward more cautious labor strategies. Slower hiring weakens consumer spending, and when spending begins to slow, the jobs data starts to crack, even if officials attempt to smooth the narrative or emphasize selective data points. In this video, you will learn what the so-called cancel China push really looks like behind the scenes and why parts of it are already struggling. You will see how employment data can appear strong while workers quietly fall behind. You will understand why technology stocks remain under pressure even as broader market commentary sounds confident and reassuring. And most importantly, you will see how all of these trends connect into one larger, coherent economic story. We will break down the claims that dominate headlines. We will separate facts from messaging. We will focus on the numbers and signals that most people never hear discussed. By the end of this video, you will understand why recent market moves are not an accident, why they are happening now, and why the next phase of this economic shift could matter even more than the last. If you're looking for clear explanations without hype or panic, you are in the right place. Welcome to the channel. And if you value calm, data-driven breakdowns of what is really happening in the economy and the markets, make sure to subscribe and stay with us until the end. The phrase cancel China has been appearing with increasing frequency in political speeches, financial commentary, and market discussions, and it has taken on a powerful emotional charge. Despite how dramatic it sounds, it does not mean cutting China off overnight or severing all economic ties in a single move. Instead, it refers to a broader and more complex strategy aimed at steadily reducing China's role in global trade, technology, and finance. This approach includes limiting China's access to advanced technologies, shifting supply chains away from Chinese factories, raising tariffs on imported goods and pressuring companies to relocate production either back to the United States or to countries considered more politically aligned. Supporters of this strategy frame it as a necessary step to protect national security, safeguard critical industries, and rebuild domestic manufacturing capacity. Critics, however, see it as a form of economic isolation that risks widespread disruption and long-term damage. This strategy did not emerge suddenly. It is the result of years of escalating trade tensions, sanctions, export controls, and regulatory restrictions that have steadily reshaped the relationship between the world's two largest economies. What is different now is not just the policy itself, but the scale and tone surrounding it. The language has become more aggressive, the stated goals sound more absolute, and the implications are broader. Markets are paying extremely close attention because even relatively small policy adjustments between the United States and China have the power to move trillions of dollars across global financial systems. In an interconnected world, words alone can shift expectations, and expectations often drive markets faster than actions. At the center of this conversation is Scott Bessent, the United States Treasury Secretary. He is not a career politician shaped primarily by electoral incentives. He comes from the world of global finance and investment, and that background gives his statements added weight. When he speaks about China, investors do not hear abstract theory or campaign rhetoric. They hear potential signals of real policy direction. His position places him at a critical crossroads where government strategy, financial stability, and investor confidence all intersect. Treasury decisions influence interest rates, capital flows, currency markets, and the management of government debt. Because of that reach, even subtle changes in tone can ripple far beyond Washington. Bessent has spoken openly about the goal of reducing dependence on China while simultaneously maintaining market stability. That balance is extremely difficult to achieve. Tough messaging may reassure domestic political audiences, but markets are far less forgiving. When statements sound firm and confrontational, yet policy actions appear delayed, inconsistent, or softened behind the scenes, uncertainty grows. And uncertainty is something markets dislike even more than clearly negative news. Investors can price in bad outcomes, but they struggle to price unpredictability. As uncertainty rises, volatility follows, and confidence weakens. What is at stake goes far beyond trade headlines or short-term market reactions. The global economy is deeply interconnected, and China is embedded across nearly every major sector. It plays a central role in manufacturing, supplies critical technology components, influences energy markets, and produces a vast share of consumer goods used worldwide. Disrupting that system affects prices, corporate profits, and employment across continents. United States workers feel the impact through hiring decisions, wage pressure, and job security. Companies feel it through higher costs, logistical delays, and supply chain instability. Markets feel it through sharper price swings and shifting capital flows. This is why every statement, every pause, and every adjustment in policy matters. The outcome influences global growth, labor markets, and financial stability at the same time. When people hear the phrase, "cancel China," it often sounds extreme, even reckless. In practice, it describes a gradual but deliberate shift rather than an abrupt break. The core objective is to reduce how much the United States relies on China for critical goods, advanced technology, and industrial capacity. This spans everything from everyday consumer products to high-end components used in defense systems, energy infrastructure, and artificial intelligence. The goal is not a clean separation, but a controlled pullback that slowly reshapes global supply chains over time. One of the primary tools in this effort is tariffs. Higher import taxes are designed to make Chinese goods less competitive in the United States market and to encourage companies to source from alternative countries or bring production back home, in theory. This creates incentives for domestic investment and supply chain diversification. In reality, tariffs also raise costs, disrupt established production networks, and introduce new layers of uncertainty. How these forces balance out is still unfolding, and that uncertainty is exactly what markets are reacting to now. Alongside tariffs, export controls have become a central pillar of this strategy. These rules determine which technologies, components, and equipment can be sold to Chinese firms, with a particular focus on semiconductors, advanced manufacturing tools, and high-performance computing systems. Over time, these restrictions are intended to slow China's progress in strategic industries that are viewed as critical to future economic and military power. Unlike tariffs, which operate through price pressure, export controls operate through access. They target the inputs that modern economies depend on, shaping not just current trade flows but long-term technological development. Another major element of this shift is technology decoupling. This goes far beyond traditional trade policy and extends into research collaboration, data sharing, and capital allocation. American companies face growing pressure to limit or end partnerships with Chinese firms, even in areas that were once considered purely commercial. Investment flows are now screened more aggressively, with greater scrutiny over where capital is going and who ultimately benefits. Supply chains are being redesigned to reduce reliance on any single country, particularly one viewed as a strategic competitor. Even software ecosystems and cloud services are increasingly divided along national or regional lines. Each individual step may appear modest on its own, but together they are reshaping how global business operates and how innovation spreads. Supporters of this approach argue that it strengthens national security and reduces long-term risk. They believe that dependence on a geopolitical rival creates vulnerabilities that cannot be ignored, especially in areas tied to defense infrastructure and advanced technology. From this perspective, higher costs and short-term disruption are acceptable trade-offs for greater control and resilience over time. Critics, however, see something very different. They view these policies as the early stages of an economic war, where cooperation gives way to containment and shared growth is replaced by strategic rivalry. In this framing, the focus shifts toward blocking access, controlling resources, and gaining leverage rather than building mutual benefit. This tension helps explain why the policy environment feels unstable. Businesses thrive on clarity, long planning horizons, and consistent rules. Constant changes in trade policy, export controls, and regulatory standards make it harder to invest, hire, and expand. Markets operate the same way. They prefer predictability over confrontation, even when the news itself is not positive. As the United States pushes to reduce reliance on China, the cost and complexity of that shift are becoming more visible across the broader economy. What once sounded like a strategic adjustment increasingly looks like a difficult and expensive transition. The claim of a disaster-level collapse comes largely from how quickly markets have reacted to rising trade tensions in 2025. Investors tend to move well ahead of confirmed outcomes, and recent policy signals have triggered rapid shifts in sentiment. When talk of tougher trade measures intensifies, traders immediately begin pricing in higher costs, weaker global growth, and lower corporate profits. That reaction alone can push markets lower before any policy is formally enacted. In other words, markets do not wait for damage to show up in earnings reports. They respond to the expectation of damage. Escalating tariffs also play a powerful psychological role. They signal confrontation rather than negotiation. For companies that depend on global supply chains, tariffs translate into thinner margins, disrupted planning, and greater uncertainty. For investors, that uncertainty often leads to sell-offs, especially in sectors that were already priced for near-perfect outcomes. Capital moves out of equities and into safer assets not because collapse is inevitable, but because risk suddenly becomes harder to quantify. When risk cannot be measured, exposure is reduced. Market moves became even more pronounced following comments from Scott Bessent. His words were dissected for clues about future policy direction, and even cautious or carefully balanced statements were interpreted as signs that tensions could deepen. In fast-moving markets, perception can matter just as much as reality. A single comment can trigger automated trading systems, amplify media narratives, and accelerate short-term declines. This feedback loop between policy messaging, headlines, and algorithmic trading can make market reactions appear sudden and extreme. At the same time, it is important to understand how markets actually function. Stocks rarely move for one reason alone. Interest rates, earnings forecasts, inflation data, global growth expectations, and geopolitical risks all interact at the same time. Trade policy is only one factor among many, but it often acts as a catalyst. It does not create every underlying weakness, but it has a way of exposing vulnerabilities that were already present. When trade tensions rise, they can bring those hidden pressures to the surface quickly, making market reactions feel abrupt even though the groundwork was laid long before. This is why market drops tied to trade news often feel sudden and dramatic. In reality, they are usually the release of pressure that has been building quietly beneath the surface for months. By the time a headline hits, expectations have already shifted, risks have already accumulated, and positioning has already become fragile. Trade news simply provides the spark that exposes what was already there. The idea of a hidden jobs crash does not come from a sudden spike in unemployment. It comes from long-term labor market trends that are easy to overlook when attention stays fixed on headline numbers. Over several decades, trade with China fundamentally reshaped large portions of the United States labor market. Manufacturing employment declined steadily as production moved overseas. Entire regions lost factories that once supported stable wages, predictable hours, and long-term career paths. Because these losses happened gradually, they were easier to absorb politically and easier to ignore statistically. Research shows that many workers displaced from manufacturing never found equivalent jobs. Some shifted into lower-paying service roles. Others left the labor force altogether. The economic damage lingered in the form of weaker communities, slower income growth, and reduced job security. These effects still shape today's economy, even though they rarely appear in monthly jobs reports or headline employment figures. Critics argue that official reporting places too much emphasis on the unemployment rate alone. Those figures can suggest stability because unemployment remains near historical averages, but they do not capture job quality, hours worked, or wage strength. A rise in part-time employment can mask declines in full-time work without triggering alarms in the top-line data. Job revisions often quietly reduce previously reported gains weeks or months later, long after the headlines have moved on. Trade policy adds another layer of strain. When tariffs rise or supply chains are disrupted, companies respond cautiously. Hiring slows before layoffs begin. Temporary contracts replace permanent roles. Wage growth stalls. These changes weaken the labor market gradually without producing a sudden shock that would register as a crisis. The result is an economy that appears healthy on paper but feels increasingly fragile to workers experiencing it firsthand. This gap between official data and lived experience fuels the perception that job losses tied to trade policy are being minimized rather than addressed. Technology stocks sit at the center of modern trade tensions, making them especially sensitive to policy shifts. Many major technology companies rely on complex global supply chains that run through Asia, including China. Components are sourced in one country, assembled in another, tested elsewhere, and shipped worldwide. When trade rules tighten or tariffs rise, costs increase and timelines break down. Even small disruptions can ripple through earnings forecasts, production schedules, and investor expectations. Export restrictions add yet another layer of pressure. Limits on selling advanced chips and manufacturing equipment reduce revenue for companies that spent years building global markets. Semiconductor controls also complicate long-term planning. Firms hesitate to invest when access to key customers can disappear overnight. Retaliatory measures from other countries deepen uncertainty and increase the risk of further restrictions down the line. Investor confidence reacts quickly to these signals. Technology stocks are often priced for strong, uninterrupted growth, leaving little margin for disappointment. When policy risk rises, valuations adjust rapidly. That adjustment shows up as sharp declines that look dramatic on charts and in headlines, even though they reflect a repricing of expectations rather than a sudden collapse of the underlying businesses. Automated trading systems and index rebalancing can intensify these market moves, pushing prices lower in a very short period of time. When certain thresholds are hit, algorithms respond instantly, selling across entire sectors rather than individual companies. This mechanical activity can accelerate declines far beyond what fundamentals alone would justify. At the same time, technology stocks are also known for powerful rebounds. Innovation cycles. Balance sheets and ongoing demand for digital services often draw buyers back in after sharp sell-offs. When fear subsides or earnings stabilize, capital flows return quickly. This pattern creates wide swings rather than a straight-line collapse. The result is a market defined by volatility, where prices move faster, reactions are stronger, and sentiment can shift rapidly as trade news evolves. Trade tensions between major economies rarely stay contained within national borders. When the United States and China adjust policy, the effects spread quickly through global markets. Modern supply chains span continents, and capital flows move almost instantly. A tariff announced in one country can alter prices, production plans, and investment decisions thousands of miles away within hours. This is why markets in Asia, Europe, and emerging economies often react within minutes of trade-related headlines. Global companies operate across borders, and their stock prices reflect that exposure. A slowdown in Chinese demand impacts exporters in Europe. Higher input costs in the United States affect manufacturers in Mexico and Southeast Asia. Commodity markets respond as well, with energy, metals, and agricultural prices shifting as expectations about trade and growth change. These movements feed directly into national stock indexes around the world. Investors do not wait for damage to appear in earnings reports. They respond to uncertainty itself. When rules become unclear or policy direction appears unstable, perceived risk rises. Funds reduce exposure, volatility increases, and capital moves towards safer assets. Even countries not directly involved in the dispute feel pressure as global portfolios rebalance. Currencies fluctuate, bond yields adjust, and liquidity tightens in unexpected parts of the financial system. This is why trade disputes carry outsized influence. They shape expectations about growth, inflation, and financial stability all at once. The reaction is less about any single headline and more about the fear of unpredictable change. Markets depend on confidence, and uncertainty weakens that foundation across the global system. When we step back from the headlines, the full picture is more nuanced than it first appears. The phrase "cancel China" sounds absolute, but in practice it is a policy label describing efforts to reduce dependence, not a complete economic separation. Trade, investment, and supply chains continue to operate even as governments impose controls and restrictions. The impact is meaningful, but it unfolds in a measured and gradual way rather than as an abrupt break. Job losses connected to trade with China are real and have shaped parts of the United States labor market for decades. Millions of manufacturing roles were affected as production shifted overseas, and some communities continue to feel those consequences today. At the same time, the overall employment picture is complex. Not every worker displaced by trade remains unemployed, and transitions into other sectors can mask long-term challenges that do not show up clearly in headline statistics. The story is not simple, and its effects vary widely by region, industry, and skill level, which is precisely why broad claims about collapse or crisis often miss the mark. Technology stocks are clearly under pressure, particularly where supply chain exposure and policy risk intersect, but that pressure should not be mistaken for total failure. What we are seeing instead is a period of adjustment. Valuations that once assumed frictionless globalization and uninterrupted growth are being recalibrated to reflect new realities. Volatility and sharp swings now dominate the narrative, reflecting heightened investor concern rather than systemic breakdown. Beneath the surface, many strong companies continue to innovate, generate revenue, and attract long-term investment, even as markets reassess risk and price in uncertainty. It is also critical to recognize that markets are influenced by a wide array of forces beyond trade policy alone. Interest rates, inflation trends, corporate earnings, geopolitical developments, and shifts in investor sentiment all interact continuously to drive stock prices. Policy headlines may act as a spark, but they do not operate in isolation. The underlying forces shaping market behavior are broader, deeper, and often slower moving than any single announcement. Understanding this interaction is essential to grasping why markets behave the way they do and why simple explanations rarely capture the full picture. Financial markets are complex systems, and reducing their movements to a single cause almost always leads to misunderstanding. Headlines, by design, grab attention, but they often do so by compressing complex developments into dramatic narratives. Market declines are labeled implosions, policy adjustments are framed as collapses, and routine shifts in employment are described as crises, even when the underlying data tells a far more measured story. Looking past this sensational language reveals an economic landscape that is constantly evolving, shaped by competing pressures and adaptive responses. Numbers and context matter, and without them, it is easy to mistake volatility for catastrophe. Economic indicators provide insight that headlines frequently overlook. Trade balances, sector-specific employment trends, corporate earnings reports, productivity measures, and supply chain disruptions together paint a clearer picture of what is actually happening beneath the surface. These data points show that while some industries are under real strain, others continue to grow, invest, and adapt to changing conditions. Understanding how these elements connect helps explain why markets can react strongly to news while underlying fundamentals remain mixed. It also clarifies why some widely shared fears may be overstated when viewed in isolation. At the same time, risks are real and should not be dismissed. Supply chain disruptions, geopolitical tensions, regulatory shifts, and elevated investor uncertainty pose tangible challenges for companies and workers alike. Businesses must navigate tariffs, export controls, and shifting demand patterns, while workers and communities often feel the indirect effects long before they show up in official statistics. Awareness of these risks allows for more informed decision-making and more accurate analysis of market trends, rather than reactive judgments driven by headlines alone. Importantly, counterforces exist as well. Strong corporate balance sheets, ongoing technological innovation, targeted government interventions, and global diversification all contribute to economic resilience. Markets are reactive, but they are also adaptive. Over time, they adjust to new information, absorb shocks, and recalibrate expectations. Even when policy changes create short-term volatility, the underlying economy often continues to function, supported by innovation, demand, and institutional stability. The constant interplay between risk and resilience creates a dynamic environment that simple narratives fail to capture. By carefully examining the data and connecting the dots between trade policy, employment trends, corporate performance, and market behavior, a more complete understanding begins to emerge. The challenges are real, but so is the tendency to exaggerate them. Context is what allows investors, workers, and policymakers to distinguish between temporary turbulence and structural change. It is this perspective that leads to smarter decisions and clearer analysis in an environment dominated by noise. Thank you for watching. Now we want to hear from you. What are your thoughts on the impact of trade tensions, the so-called canceled China policy, and the pressure-facing technology stocks? Share your perspective in the comments below. If you found this video helpful and want more clear data-driven insights into markets and the economy, make sure to like the video and subscribe to the channel. Stay tuned for upcoming episodes where we cut through the headlines, uncover hidden market trends, and help you understand what is really happening in the world of finance.